Oscar Wilde defined a cynic as somebody who knew the price of everything and the value of nothing. And I wonder, in the tsunami of passive investing, whether in fact it's created a feast for the diligent value hunters.
Feast or famine? I don't know. But that's actually a really good quote, because I don't think it describes the value investors, but I think it describes the vast majority of market participants. First of all, thank you guys for having me. I was flattered to get the invitation, and I was a little startled to realize that there's still value investors left. There you are. This is really, really wonderful. I was glad we're not at the Natural History Museum or something with the dinosaurs. I've made the comment before that the value investing industry has had irreparable damage, is unlikely to recover in a material way. But the corollary of that is that value investing, for those that remain, I think is an extraordinarily exciting time. The key is to recognize how the landscape has changed and not continue trying to do things the old way that aren't going to work in the current market structure, but are much more likely to work, that are opportunities that are created from, I would call it, the defects and the opportunities that are created by the new market structure. Let me explain the way that I would tend to have looked at things a long time ago, which is our business was buy things that are sort of cheap, figure out that they're going to be a bit better or maybe quite a bit better than the world generally understands, often purchasing at times of dislocation, like around when a spinoff happens or when there's extraordinarily bad news relating to a particular company and people are being emotional and selling. Figure out that things either aren't that bad or they're a little bit better, and then patiently wait for 3 months to go by, 6 months to go by, the world to see that it's not quite as bad as you thought, and have the traditional long-only retirement funds, the big mutual fund complexes and whatnot, come in and buy the stocks. And they were so big in the market. Those were the dominant forces in the market that once they started buying, it was going to take them 6 months, 9 months, a year to accumulate their position. And you could just ride that flow the whole time. So the very simple is, if you think it's at $10 and the world thinks it's going to earn $1 and you think it's going to earn $1.15, we were never really in the beat it by a penny business, but beat it by 15% is pretty good. And then you wait forward a year and they've made $1.15 instead of $1, and now it looks like they'll earn $1.35 the following year, and you get a 13 multiple on the $1.35, and you paid a 10 multiple on the 10, you just made 60, 70% over 12 to 18 months as that's played its way through. Really was what our business was. But the problem is that those buyers aren't there anymore. They don't have new money. They don't have daily flows. They've been turned passive. The fees that they have for their active business have been cut dramatically, so they've cut their research staffs. They have to sell something to buy something. They're not looking for that new opportunity the way that they had when they were getting constant positive flows. And so if you play out that same story and it's supposed to earn $1 and it turns out to earn $1.15, and you think now it's going to earn $1.35, maybe the stock is going to be 11 at the end of that 18 months, and you'll have made 6% on your money, which beats losing, and it's better than cash and so forth, but it's not really the exciting result that you were able to get a year and a half ago. So what's changed? What do you do if you're not going to be able to do that? And so I would caution people not to continue doing that, because those subsequent buyers, they're just not there, and they're not there with capital. The capital that's trading in the markets are passive flows, they're index flows, they're ETF flows, they're sector rotations, there's correlation trades, where there's times when the machines are going to want to buy a particular sector or an industry, and one day the financials are up, and the next day the oil companies are up, and so on and so forth. This is where the actual trading in the market is, in addition to all the algorithms, which are just trying to figure out what everybody else is doing and how they're positioned, and try to trade at 1 nanosecond before you and be right 56% of the time and never have a down day. That's what the market now consists of. Those big, long-only behemoths, they don't have the footprint in the market that they did. So what does that leave for us? And how have we adjusted our strategy, which is we're not doing what we were doing anymore. What we're doing now is we're saying, what do we have to do to make a good return if a tree falls in a forest and nobody is there to hear it? What happens if there aren't other investors who are going to bid up the stocks and figure out what we have figured out after we figured it out? Because that's what we used to do. And so what you need is companies that are earning. The result of this, though, is that you have this enormously bifurcated market where there's this wasteland of companies where literally nobody is paying attention and nobody is following. And maybe they're sell-side analysts, but sell-side analysts don't matter. They don't have any money. They don't have any customers. And the fact that they don't have any customers with any money is the important thing. It doesn't matter if there's 10 analysts recommending a stock if they don't have any customers that are going to follow the recommendations. The point is there's no buyers. And so you can have these companies that are essentially at a wasteland valuation. You have a bifurcation. Index investing, by definition, overweights whatever is most overvalued, underweights whatever is most undervalued. Money coming out of active put into passive is two trades. It means that there's a sell of the undervalued things and a buy of the overvalued things. And you have a divergence from fair value as opposed to a convergence to fair value. And then people do this for a while, and then they realize, look at that, the index already was overweight the things that did better. So let's get more money into index and let's have more redemptions from active managers. And then at the very end of the cycle, they say, who was the active manager that already owned all the overvalued things because that went up the most? That's your performer. And then you redeem from the value people and put it into the innovation people or something like this. So you saw how that all ended, and that's all played itself out. The good news is I think that most of the active managers who are going to be fired have been fired. Those switches have happened. All of those active equities mandates have converted to passive. I don't see the negative half of that trade continuing, but you have these washed out securities. And if they're trading now, instead of buying it at 10 times earnings because you think that they're going to beat, you can buy that same type of situation at 4 times earnings. Or 5 times earnings. And then you may not know whether it's going to beat. If you're wrong by 10%, a 5 multiple becomes 5.5. And there's nobody who cares anyway. Nobody's going to sell because they missed by 10%. So you don't really have to get your forecast right. You need to just start at such a low value. And if you do it in unlevered companies that are taking the vast majority of that earnings yield and giving it to you in dividends or buybacks, this has to work itself out over time in a favorable way. If you are buying back 15% of your company, the stock goes up, or in 6.5 years, there's no stock left. And the last share is the golden share. And that's what we want to own.